Hello and welcome. My name is Benoit Poliquin. I'm the founder of Exponent Investment Management and one of the portfolio managers. You're watching the first quarter review of 2026. Let's get started with our first slide, which is always the performance. And it was an interesting quarter. Now, there's a lot of geopolitical highlights or events or headlines, whatever you want to call it. Yet the Canadian market did very well, obviously on the back of oil prices going up. But the one-year performance and three-year performance on an annualized basis is still well above trend. If the trend long-term equity returns over, say, a 10 or 15-year period, depending on what your starting point is, should be around 7, 8, or 9%, and we're well above trend here. In terms of the S&P 500, well, technology names really had a difficult time, which is kind of ironic because it's one of the few sectors that don't depend on geography in terms of oil prices. So the NASDAQ generated a negative 7% return for the quarter. We're still generating healthy annualized returns. And the S&P 500, which is about 40% technology, had a minus 3% return, as you can see there, and still is tracking at a high number. The European markets, they were up, even though it's an economy that does depend on Middle East oil. And you can see, for those of you that have been listening to the videos consistently, this time last year, this three-year return and this one-year return was closer to zero. So really, the European markets have turned around. The emerging markets, which are comprised of roughly 50% Chinese equities, they also depend on Middle East oil. They turned in a slightly positive return for the quarter of 1.6%. And they also have trended very well over a 3-year and over a 1-year period. The US dollar is basically flat versus our loonie. It's down about 5% on a rolling 12 months basis and slightly down for the quarter. Bonds, nothing going on there for the past 3 years. You would have earned basically what the coupons or the interest that you're getting on the bonds. Again, flat returns. Canadian interest rates have risen slightly, which has hurt bonds, and which basically negates the income that you would have earned over the past 12 months. And then the price has fallen, or the total return of the bonds, I should say, down 0.7%. Oil prices have rocketed up 80% for the quarter. No surprise there. Gold prices still kind of flat for the quarter, still showing some very strong returns. On the interest rate side of things, if I zoom in a little bit here, if you want to lend money to the Canadian government, you're going to get about 3.5% over 10 years. 5 years, you can get just above 3, and over a 1-year basis, you can get 2.6. In terms of GICs typically pay about 1% or 100 basis points above what you can get from a government bond. And so you're at 3.6 on the 1 year and 4% on the 5 year. So in early March, I was getting a few emails and maybe 1 or 2 phone calls about the headlines. And I was trying to, basically, markets don't care about headlines. At the end of the day, investors only care about just a few things. What they really care about is earnings growth and those expectations, and the interest rates, and more importantly, where those interest rates are expected to be. That's what moved markets. Geopolitically, yeah, you'll have a softness, very short term, few weeks. If you go back in time, the previous Gulf Wars, Ukraine invasion, they are terrible human tragedies. However, from a pure investment perspective, it's not something investors are focusing on. So the discounted cash flow, that's how you value a business. So you basically lay out I'll show you the formula for those of you that are more visual, but effectively you sort of map out all the future cash flows or profits, and then you use prevailing interest rates to discount and to get to a present value of those future cash flows. So the variables really is the cost of capital, another way to call it, interest rates, and the future profits. That's really what investors are focusing on. And currently, I'll show you a little later, profits are going up and interest rates are stable. That's why the market softened, but a lot less than many pundits expected, especially if you're someone that is very close to the geopolitical scene. So in this case, this is the formula for a present value calculation. this is pure math. Investors, R is the interest rate, and future cash flows is the sums of all the future cash flows or profits. So at the end of the day, if this denominator here, the R, interest rates, comes down, the value goes up. If rates go up, values come down. Even if the cash flows are also going up, there's a relationship there, but basically, assuming cash flows stay the same or the expectations of future cash flows, interest rates, just that change alone will change the price of an asset. Alternatively, if rates stay the same and cash flows are still expected to grow, well, price kind of stays the same. So only in times, 2022 when the markets were really suffering, it's because this R here went up. Surprised all investors. The 10-year bond rate went from basically 1% to 5% in 12 months. And that was a surprise to everyone. So in this case, in 2022, profits didn't really change, or profit expectations were the interest rates. In 2020, during COVID, when we were all locked down, interest rates fell, but profit expectations fell faster, so the value of stocks went down. Just showing you the same returns visually. So this is what happened in the quarter for the TSX on the left and the S&P 500 on the right. It's just sort of a price chart. You can see the geopolitical events kind of making the prices come off here a little bit. But we were at basically all-time highs. So that's also something to remember. And the end of the quarter is right here and right here. So as the time of the recording, the markets are basically right back to where they were before the geopolitical event started. So it's important to remember, another concept I wanted to show is that markets tend to turn when the news gets less bad. Now, many investors are waiting for the all clear, and it's just too late. So really, it's when the news flow of whatever geopolitical event or whatever it is, when it starts to get less bad, that's when stocks and or markets turn to the good. The reverse is also true. If the bad headlines is accelerating, investors get nervous. So here what we're looking at is the VIX, or the volatility index. And around the office, we kind of call it the anxiety index. So you kind of, when investors get more and more anxious, the stocks are more volatile, they're moving down more, and so that index goes up. So we can see at the beginning of March, the VIX kind of effectively went from, let's call it 18 or 19 just in late February to over 30. And so that's a sign of anxiety. Now, 30 is not, the death knell of markets, but is sort of a sign of high anxiety on the part of investors. And we can see since the end of the quarter that the anxiety is really coming off. The news flow is getting less bad. Doesn't mean it's solved. It's just that news flow, those headlines are getting less bad. Some people will say, well, investors are just getting used to it, and so they now live with it. Companies have learned to get around the problem. All sorts of those things might all be true. So here's a table. I couldn't find the same sort of term for the S&P 500, but it will track, for the TSX. But this is the table, the earnings growth and the change in earnings expectations from a quarter ago to this quarter. So here, info technology, let's call it tech, profit expectations actually went up at the end of last year. So 3 months ago, we were expecting, or investors were expecting 34% growth. They're at 45 now. We see flat energy growth expectations moving up to 9%. So when you have a big move like that, obviously the stock prices will react. I'll draw you back to, or draw your attention back to the equation that I showed you just a few slides ago. So it's just math. That's all it is. So when you have sort of profit expectations that fall, say in healthcare or here in consumer staples, then you have obviously prices falling. So earnings and interest rates, that's what investors are focusing on. A lot of questions we're getting are around AI and our view of AI. So I wanted to get a little philosophical with you. The first one is all new technology, whether it's AI, cars, telecom, radios, railways, all go through this concept that was illustrated or developed by a call him the early 20th century economist called Joseph Schumpeter, and it's called creative destruction. So the concept is always the same. The arc, it follows the same concept. So at the top, it's the there's a new innovation, it emerges, and then capital floods to the opportunity, and eventually it leads to overinvestment. I mean, at the end of the day, investors all think they're the best one. They all think they have the best mousetrap. And if you have multiple investors thinking the same thing, the returns on those investments eventually compresses to the point where they don't make any money, and the weaker players sort of fail out. So, early 1900s, you had over 200 cars in Detroit. 15 years later, you were down to basically half a dozen to a dozen. So that's a normal part of creative destruction. What happens is effectively you get sort of, but all that funding creates the infrastructure. So in this case, it would be the AI infrastructure. And what that does, which is very, very interesting and often forgotten, and I don't think discussed enough, is it creates an oversupply and drives down prices of that new infrastructure. It could be AI, it could be railway tracks, it could be, I'll use the example of telecom in the early 2000s because many of us were around for that. There was a tremendous oversupply of the ability to move bits over distances through fiber optics and telecom networks. There was an overbuild. That compressed prices of the cost of moving those bits, which then spawned a whole new series of industries and new winners. Think of a smartphone wouldn't have existed without the overbuilding of the telecom network. And so that's the same expectation here with AI. It will follow the same type of path. It doesn't necessarily mean that we're going to have a 2000 crash. My point here is because you've had overinvestments where that didn't lead to crashes, I should say, but they always lead to the same thing, which is a new set of winners. The other concept, which is interesting, is Jevons paradox. So in other words, as an asset becomes cheaper, more efficient to use, the usage actually goes up. And that also spawns new economic activities and new businesses. So one can think of, AI use in radiology and scans. Well, if the cost of a scan and the time it takes to have a patient go through the scanning procedure, you're going to have more of them, and you're actually going to have a need for more radiologists, not less, because you're going to have more scans. That's the Jevons paradox. And so those two concepts they always play with each other when there's a new innovation that comes in and disrupts. So again, you can Google it. They're great stories. The automobile industry, in the late 1800s, I think 1/5 of all the U.S. population was that was working was involved in the horse business. Whether you were raising horses, moving them around, taking care of them, feeding them, or the businesses that fed into those main 5 industries. And 30 years later, it was all gone. But people got new jobs, the new industries emerged, and it couldn't have happened had the automobile industry not happened. And obviously the automobile industry then spawned a whole new set of industries, refineries, road building, it enabled urban centers to develop, and so on and so forth. So there's a lot of doomsayers around AI, but this cycle, the creative destruction and the Jevons paradox, please read up on it, and it should sort of settle down some of the fears that you might have. We've all seen this chart. If you've read a little bit about it, what is sort of the capabilities and what are the risks to AI? So what is our approach to AI? Well, this chart was important because we're looking for companies where there's a big lift in terms of how companies can leverage AI. How can they make or improve their operations? So we're still looking for well-managed companies, strong balance sheets, consistent cash flows. That doesn't change. But some companies tend to be better at developing new markets when new innovations come in, or other companies just integrate the new technologies better, and they've done so in the past. So the one change is we are sort of incorporating the concept of what companies would benefit from AI, and obviously staying away from the ones that are at risk. Now, the risks sometimes are overbaked. In the past quarter, we sort of bought software companies. That whole sector was really decimated by fears of AI. And in certain sectors, especially the regulated sectors, think accounting, tax, law, AI sounds great, but a lot of them, it's actually worth another video, but it's just the threat of AI is not as fierce as investors are worried about. So AI does not drive our decision making at all. We do leverage AI, but it's here at Exponent, but it certainly doesn't make our decisions. So in practice, we're focusing on a measured AI exposure, looking for indirect beneficiaries, what we internally call the toll keepers. And cash generation is paramount. So our key takeaways for the quarter. So markets either stayed somewhat flat or even went up in the case of Canada's, Europe, or even emerging markets, despite the headlines. Profit growth and interest rates it's a reminder that's really what matters, and interest rates are stable and profits are expected to grow. And AI is still part of the conversation. Our strategy doesn't really change. It evolves a little bit. As I mentioned earlier, AI is something that we are taking more and more seriously, but not necessarily driving our investment decisions. And some neat news on the firm perspective. So on one hand, John Vachon, we've expanded our ability on the estate planning side, and John Vachon is spearheading those efforts. He's been here with us for a year, and we're very, very fortunate to have him help us, whether it's reviewing existing insurance policies, improve tax efficiency, and the whole tax and estate transfer conversation. It really is something that dovetails nicely into our financial planning, but it's something that we now can do in-house. A lot of clients are starting to ask more and more about philanthropic objectives. And again, John is able to spearhead those efforts. In terms of the next generation, if you've taken a look at our website, you can see that all of us are either losing our hair or turning gray. And so as a corporate leader, I've recognized that and working hard on bringing on the next generation. So you've all dealt with whether it's Gabrielle or Daryl, and Mitch Cadieux comes on. He's a CFA and he's associate portfolio manager, and he'll be working alongside me, I should say, on the advisory role, on some of the roles that I take on, and supporting new clients that are coming to the firm. And finally, to contribute and to continue the fresh eyes on the client experience. So many of you will be working and meeting with Mitch over the coming months. If you have any questions or comments, as always, please drop us a line at this email. Thank you very much for watching.